Most traders spend years trying to win. They learn strategies, backtest obsessively, tweak indicators like mad scientists, all because they believe the path to success is about being right more often. But what if that belief is the very reason they're stuck? What if you've been playing the wrong game all along? Here's a brutal truth that no trading guru will tell you. You can be right 30% of the time and still be rich, if you don't die first. But that's the part most traders miss. They blow up not because they don't know enough, but because they weren't built to survive when things go wrong. They had no contingency, no safety net, no armor. Welcome to Trading Psychology Stick, where we dive deep into the mental game behind every winning trade. Quick disclaimer, this isn't financial advice. I'm sharing educational content based on my experience and research. Always do your own due diligence before risking real money. Let me tell you about January 15th, 2015, a day that should be burned into every trader's memory. The Swiss National Bank shocks the world by abandoning its currency peg to the euro. In less than 20 minutes, EUR-CHF drops over 2,000 pips. Major brokers like FXCM go insolvent. Traders watch in disbelief as stop losses slip by thousands of pips. Some lose entire life savings. Others wake up owing their brokers tens of thousands overnight. One trader survived. We'll call him Daniel. He was actually long EUR-CHF with leverage. Should have been destroyed. But Daniel had set a hedge order 2,000 pips away days before. It seemed pointless at the time, just in case, he had told himself. That hedge triggered mid-collapse. His account ended that day at break-even. While thousands were erased, Daniel didn't win. He survived, and that was enough. That's hedging, not as a technique but as a philosophy. In this video, you're going to learn how to think like Daniel, how to build systems that keep you alive when markets turn into monsters. And by the time we're done, you'll never look at risk the same way again. Because this isn't about being perfect, it's about being durable. Let's begin. Part 1. The Mindset Revolution, from panic button to power tool. Hedging isn't what you think it is. It's not a panic button. It's not a safety rope you throw when your position's bleeding red. It's not something you activate when your hands are shaking and you're whispering to yourself, just one more chance. That's not hedging. That's fear in disguise. True hedging happens long before the fear arrives. It's calculated, cold, surgical, and, ironically, it has very little to do with feeling safe. In fact, the traders who hedge best are often the least emotional about it. They don't hedge because they're scared. They hedge because they understand one thing that most retail traders never grasp. Control is an illusion, but structure is real. Let me ask you something right now. Have you ever found yourself opening a hedge just because you couldn't emotionally handle closing the losing position? Be honest. Type yes in the comments if this has happened to you. That wasn't hedging. That was ego preservation dressed up as strategy. Think about it this way. You're driving on a highway. Do you put on your seatbelt because you're planning to crash? No. You put it on because you understand that no matter how good a driver you are, things can happen. That's hedging. It's not about expecting failure. It's about respecting uncertainty. Two traders enter the same market. Both have the same strategy, same entry, same setup. But one has a hedge plan, a predefined rule that says if price moves against him by a certain amount, he opens a counter position, not to escape, but to reduce exposure while evaluating the next move. The other trader, he watches his trade tank, panics, then opens a hedge emotionally, gets stuck in a death spiral, over-hedging, draining margin, paralyzed by indecision. This is the dark side of hedging no one warns you about. When it's done reactively, it becomes a psychological trap. But here's the shift. Hedging isn't emotional, it's mechanical. Like a pilot switching to emergency fuel tanks mid-air, not because he's crashing, but because he planned for turbulence. The professionals view hedging as a lever. They use it to reset, to buy time, to force the market to show its hand. They don't hedge out of desperation, they hedge from dominance. Now imagine if before you entered your last losing trade, you already knew your hedge level, already calculated the size, the exit scenario. Now it's no longer fear, it's structure, no longer chaos, but chess. And speaking of structure, let me show you the embarrassingly simple math that could have saved thousands of accounts over the years. Part 2, the foundation. Hedging 101 plus. The math that saves lives. Let me break this down as simply as possible. Hedging is one core idea, opposing exposure. When you're long one asset and short a correlated or identical asset, you're hedged. That's it. The devil is in the execution. Think of it like walking on ice. Instead of just hoping you won't slip, you spread your arms for balance. Each arm counterbalances the other. That's hedging in its purest form. In Forex, the simplest form is a direct hedge. You go long EUR USD at 1,000. Price drops. Instead of closing at a loss, you open a short EUR USD position. Same pair, but opposite direction. You've hedged. But here's the catch. What now? You're frozen. You've locked your loss. And if you don't have a plan for what comes next, you're no longer trading. You're trapped. That's why most people say hedging doesn't work. Because they don't know how to exit a hedge. They use it like a fire extinguisher, not a bridge. Here's the math that changes everything. And I promise, if you can calculate a restaurant tip, you can master this. The 1.5x rule. If your trade risks $100, your hedge should protect $150. Why 150? Think of it like this. You fall into a hole that's 10 feet deep. To get out, you don't just need a 10-foot ladder. You need a 15-foot ladder so you can climb above ground level. Same concept. Real example. You buy one lot of EUR USD. Price drops 20 pips against you. That's a $200 loss. Instead of closing, you open a sell. But not one lot. You sell 1.5 lots. Now if price drops another 20 pips, your sell makes $300 while your buy loses another $200. Net result? You're up $100. You've turned a losing situation into a small win. But wait, you might ask. What if price reverses and goes back up? Good question. This is where your exit rules matter. You don't hold both positions forever. You have clear levels where you close everything. Here's a basic framework anyone can use. 1. Open a buy on GBP USD at $13,000. Stop loss at 1.2980. Take profit at 1.3060. 3. If price hits 1.2980, system triggers a sell at 1.5x size. 4. Set sell target to recover loss plus small profit. 5. If price returns to entry area, close all positions. This creates what I call a hedge zone, a price range where you're no longer betting on direction. You're operating within a safe corridor, waiting for market clarity. Quick mini recap. So far we've covered two game-changing concepts. First, hedging is mechanical, not emotional. It's about structure, not fear. Second, the 1.5x rule turns losses into potential break-evens or small wins. Simple math, powerful results. Now here's a breathing moment. I once met a trader who'd been profitable for 20 years. His entire system, 3 rules written on an index card. If down 2%, hedge at 1.5x size. If hedge profits hit original loss amount, close everything. Never add more than 3 hedges. That's it. The best math is simple math applied consistently. Ready to build your own survival system? Let's do it. Part 3. Your survival. Blueprint building the system. Plus risk rules that save accounts. It's 2 a.m., the market spikes without warning, your trade's in the red. But you don't panic, you don't close, you don't freeze. Because this time, you're not reacting. You're executing. You built this hedge system in advance. A hedge strategy without a system is like a recipe without measurements. Sounds good in theory, useless in practice. So, let's build one together. Really build it. The 6 essential elements. Write these down. 1. Entry trigger. What makes you open the initial trade? Don't say when it feels right. Real trigger. Price level, pattern, indicator signal. 2. Hedge trigger. Does it activate at fixed loss? 2%? 20 pips? Time-based? Pick one and stick to it. 3. Size logic. We've covered the 1.5x rule, but decide, will every hedge be 1.5x, or does it scale? 4. Exit rules. When do you close both positions? When one hits profit? When price returns to entry? Define it clearly. 5. The emergency brake. Maximum hedge layers. Most pros cap at 3 to 5. Why? Let me show you. 6. Timing filters. Will you hedge during news? Overnight? Sometimes the best hedge is not trading at all. The margin death spiral. Why layer limits matter. Picture this. Bitcoin crashes from $58,000 to $30,000 in May 2021. One trader using an automated grid bot had no layer cap. Price trended down. He kept hedging every 1%. After 12 levels, his bot had opened 5 Bitcoin worth of counter trades. Margin hit 100%, liquidated. Every hedge uses margin. Stack too many and your account suffocates. Like putting on winter clothes. 1 jacket, fine. 5 jackets, you can't move. Pre-calculate your survival. How much margin at 2 hedge levels? At 3 levels? At 5 levels? Where's your death point? If you can't answer this, you're flying blind. Hidden costs. That kill, the things nobody mentions. Spreads on every entry-exit. Swap fees for overnight positions. Funding rates in crypto can be 0.1% every 8 hours. Opportunity cost of locked capital. Real example. A Forex trader hedged EUR/USD manually, perfect floating P&L of 0. But after 2 weeks of swaps, down 20%. The hedge protected nothing. It bled him slowly. Your emergency brake system. Rule 1. Max to 315 hedge layers. Pick your number. Rule 2. If margin usage hits 50%, no new hedges. Rule 3. Time limit. If hedge unsolved in X days, exit. Rule 4. Factor 20% buffer for hidden costs. Pattern interrupt. Stop right now. Take your last losing trade. Calculate what would have happened with these rules. Don't worry about perfect execution. Just see the numbers. Would you have survived? Share your discovery in the comments. Want to test without risking money? Good. Open a demo account. Place 20 trades using these rules. Track everything. What worked? What didn't? Where did you break your own rules? Because you will. We all do it first. The difference between amateur and professional isn't perfection. It's iteration. Mini CTA. Design your hedge system using the 6 elements. Post just your hedge trigger and max layers in the comments. I'll review some personally. Remember, you're not aiming for perfect. You're aiming for a starting point. Now let's look at what happens when these systems meet reality. Part 4. Blood on the streets, real stories, plus the psychology of survival. June 2016. Brexit vote. The pound is expected to stay strong. Polls show Remain winning. One trader in Malaysia isn't sure. She doesn't try to predict. Instead, she opens both long and short positions on GBP USD. Different sizes, 1 lot long, 1.5 lots short. The results start coming in. The pound collapses of 1,300 pips in hours. Her long hits stop fast. Her short runs for nearly 1,000 pips. She didn't predict Brexit. She priced in her uncertainty. She cashed out while others posted margin calls on Reddit. But it's not all success stories. Same year, different trader. He watched GBP USD tank, opened a panic hedge at the bottom, then another, no plan, no exit strategy, just emotional reaction. The pound eventually bounced. Both his positions bled. He closed for a massive loss on both sides. The market didn't beat him. His psychology did. The 3 psychological traps that kill hedge traders. 1. The emotional hedge. You're in a losing trade. Instead of closing, you open the opposite position, hoping it will buy time. But you've really just locked in uncertainty. Now you're frozen. Which one do I close? Should I add more? The hedge becomes a prison. You're watching price, not executing rules. 2. The revenge hedge. You get stopped out. Frustrated, you immediately hedge the opposite direction with larger size. Not because of logic, but emotion. You're trying to win it back, but the market doesn't owe you anything. By the time you realize you're chasing, you're down on both sides. 3. The overconfidence trap. You've built a hedge system. You feel untouchable. You stack layers, confident in your math. But confidence without discipline is just hubris in disguise. You ignore margin limits. You forget trend structure. You believe your system is smarter than the market. That's when the market teaches you humility. Breathing moment. Let me share something personal. I once held a hedge for 3 days, both positions bleeding from spreads, neither side winning. I knew I should close but couldn't accept the small loss. Finally, exhausted, I closed everything for a tiny loss. The moment I closed, the market moved hard in my original direction. But here's the thing. That wasn't bad luck. That was bad psychology. The market didn't beat me. I beat myself. So, what's the solution? The 3 questions that save your trading. Before you hedge, ask yourself, 1. Is this part of my plan, or am I running from pain? 2. Can I handle the worst-case scenario emotionally? 3. Am I hedging the position or my ego? If any answer makes you pause, don't hedge. Simple as that. The pre-mortem exercise. Before you trade, mentally rehearse the disasters. Can you watch a hedge run into drawdown without flinching? Can you close both legs at break even after hours of tension? Will you follow your cap rule when the fifth layer is underwater? Or will you tell yourself, this time's different? The best hedge traders aren't calm because they feel safe. They're calm because they've already accepted the risk before the trade began. They don't hedge because they're afraid. They hedge because they're responsible. Engagement. Hook. Think about your worst trading loss, the one that still stings. If you had proper hedging with the right psychology, how different would the outcome have been? Don't just think money. Think about confidence lost, time spent recovering. Share your biggest psychological trading challenge in the comments. Now, let's talk about something that can destroy your hedge system before you even start. Part 5. The invisible battlefield. Platforms, brokers, and regulatory traps. You've built the perfect system, calculated every variable. Your psychology is bulletproof. You fund your account, place your first hedge, and immediately get a warning. Hedging not permitted. Positions netted. Your entire strategy, dead on arrival. Welcome to the invisible battlefield of regulations and platforms, where traders lose not because they're wrong, but because they didn't read the fine print. The U.S. trader's nightmare. If you're in the United States, the NFA enforces FIFO rules. First in, first out. Try to hedge EUR/USD. Your broker will automatically close your first position. This isn't the broker being difficult, it's the law. Your options. Use an offshore broker, but lose regulatory protection. Trade different correlated pairs, EUR/USD long, GBP/USD short. Use options instead of spot positions. Or accept you can't hedge directly. Platform reality check. MetaTrader 4-5. Still the workhorses for Forex hedging. Shows both positions clearly, but only if your broker allows it. Boring, but reliable. Crypto exchanges. Most allow hedging through futures. Binance, Bybit, OKX, all work. But beware of funding fees. Every 8 hours, you pay or receive money. During volatile times, these fees can destroy profits faster than losses. U.S. brokers. Thinkorswim, Tasty Trade won't allow direct Forex hedging, but they offer options which can achieve similar results. Pattern interrupt. A trader learned this the hard way, built a beautiful hedge system, tested thoroughly, funded $10,000. First trade, blocked. He never checked if his broker actually allowed hedging. Expensive lesson in reading terms of service. The offshore dilemma. Offshore doesn't mean unsafe, but it means less protection. No SIPC insurance. Harder to recover funds if broker disappears. Less regulatory oversight. But full hedging allowed popular offshore options. IC markets, Pepperstone, FX Pro, but always verify current policies. The tax bomb. Nobody mentions every closed position equals taxable event. In some countries, you owe tax on winning legs even if net negative. 100 hedge trades equals 100 taxable events. One trader made 500 hedge trades, broke even on profit, spent $2,000 on tax preparation. Your pre-flight checklist, before you deposit anywhere. 1. Does this broker explicitly allow hedging? 2. What are the margin requirements for hedge positions? 3. Is the broker regulated somewhere with real oversight? 4. What happens to your funds if they go under? 5. Have you tested with small amounts first? Quick test. Try opening opposing positions on demo. See what happens. Some brokers say they allow hedging, but have weird restrictions. The hidden cost of free. That commission-free broker? They make money somewhere. Wider spreads, hidden cost per trade, payment for order flow, worse fills, interest on your idle balance, restrictions on strategies like hedging. Mini recap. Regulations can kill your strategy before you start. Platforms determine what's possible. Offshore gives freedom, but less protection. Taxes complicate everything. Know the battlefield before you fight. Share in the comments. What platform are you using? Does it actually allow the hedging we've discussed? If unsure, describe what happens when you try opposing positions. Now, let's peek behind the curtain at how the giants of finance use these same concepts. Part 6. Institutional secrets from walking to flying. Think hedging is just for scared traders? Let me blow your mind. Goldman Sachs, JP Morgan, Bridgewater. They hedge everything always. Not because they're afraid, because they understand something most retail traders don't. It's not about being right, it's about being solvent. The Bridgewater revelation. Ray Dalio's all-weather portfolio is literally built as one massive hedge. Long stocks for growth, long bonds for deflation, long commodities for inflation, long gold for crisis. The goal isn't maximum returns. It's survival in any economic weather. That's why it's called all-weather. They're not predicting, they're preparing. The Susquehanna secret. New traders at this giant prop firm don't touch markets for weeks. They play poker, board games, simulations, learning risk management before they learn to make money. First lesson isn't how to win, it's how not to lose everything when wrong. Now let me show you the Swiss Army knife that institutions use every single day. Options, insurance for traders. Imagine this. You're long Ethereum at $2,000, bullish but nervous about a crash. Instead of selling or hedging with a short, you buy a put option at $1,800. This gives you the right to sell ETH at $1,800, no matter how low it goes. If ETH crashes to $1,000, your put is worth $800, offsetting most of your loss. If ETH rallies to $3,000, you only lose the small option premium, maybe $50. It's like buying insurance on your house. You hope you never need it, but you sleep better knowing it's there. Visual shift. This isn't walking anymore. This is flying. Same destination, completely different experience. The straddle strategy. Betting on movement, not direction. Buy both a call and a put at the same strike. You profit if market moves big in either direction. You lose only if market stays flat. Perfect for events like earnings, Fed meetings, elections. The basis trade, free money. In crypto, futures often trade at premium to spot. Buy Bitcoin spot at $50,000. Sell Bitcoin futures at $51,000. Lock in $1,000 profit regardless of where price goes. Not exciting, but institutions do this all day, every day. Small edges, compounded infinitely. Which tool for which problem? Options. When you want protection, but keep upside. Futures. When harvesting structural differences. Correlated pairs. When regulations block direct hedging. CFDs. When you need flexible sizing. The mistake is thinking you need all of them. You don't. Master one before moving to the next. Most successful institutional traders use just one or two really well. From individual trades to portfolio architecture, institutions don't think, how do I hedge this trade? They think, how do I structure my entire portfolio to survive anything? Example, you have 5 positions: tech stocks, growth bet, Bitcoin, risk on bet, gold, safety bet, oil, inflation bet, EUR/USD, dollar weakness bet. Looks diversified until Fed raises rates. Everything crashes together. Your diversification was an illusion. You had one bet expressed 5 ways. Real diversification means finding assets that move opposite in crisis. When stocks crash, what rises? Volatility. Bonds, usually. Dollar, sometimes. That's portfolio hedging. The 80-20 portfolio structure, 80% in your core strategy, 20% in crisis hedging, rebalance quarterly, sleep peacefully. This is how institutions think. Not will this trade work, but what kills my entire portfolio and how do I protect against it? Breathing moment. When I learned this, it changed everything. I stopped asking, how can I make the most money? And started asking, how can I lose the least when I'm wrong? That shift is the difference between retail and institutional thinking. Ready to take this to the next level? Let's talk about making your computer do the hard work. Part 7. The automated edge. From manual control to systematic survival. Picture this. Market drops 2.3% in 5 minutes. Your screen doesn't blink. Your hands don't move. But under the hood, your system has already calculated exposure drift, triggered a counter position, adjusted sizing, and set exit parameters, all while you're getting coffee. That's algorithmic hedging, and it's not just for Wall Street anymore. The simple framework that actually works. Monitor price every 5 minutes. If down 2% from entry, Open Hedge at 1.5x size. Set Hedge TP at original loss amount. If both positions flat, close all maximum 3 hedge layers. 5 rules. You could code this in an afternoon. The beauty isn't speed, it's consistency. Humans break rules when scared. Bots don't get scared. Platforms for beginners. TradingView, Visual Strategy Builder, no coding needed. 3 commas, drag and drop conditions. MT4, 5. Expert advisors, more complex but powerful. The 3 deadly automation mistakes. 1. The complexity trap. Just because you can code complex strategies doesn't mean you should. The best automated systems are embarrassingly simple. 2. Set and forget fantasy. Bots need maintenance. Markets change. What worked last year might blow up this year. 3. The override problem. Your bot is running perfectly. You panic and turn it off. Or worse, manually interfere. Now you have broken automation and emotional trading. Kill switches that save accounts, max loss per day, 2% equals shutdown. Max trades per day, 10 equals stop. Margin usage, 50% equals halt. All unusual, spread widening equals pause. Because the only thing worse than a bad trade is a bot making bad trades while you sleep. Breathing moment. My first automated hedge system was beautiful in backtest. Live. It blew up in 2 days. Why? I hadn't accounted for spread widening during news. The bot kept entering and exiting, bleeding money on spreads. Expensive lesson, test everything. Now let's talk about correlation, the invisible force that breaks most diversified portfolios. Portfolio correlation, the hidden killer. Remember our 5-position example? When Fed raised rates, everything crashed together. That's correlation going to 1. In crisis, everything moves as 1. Dynamic portfolio. Hedging. Track 30-day correlation between your positions. When correlation rises, increase hedges. When correlation falls, reduce hedges. Like adjusting insurance based on hurricane season. Simple correlation. Check, make a spreadsheet. Track daily percent changes of all positions. If they're moving together more than 70% of the time, you're not diversified. You're concentrated. The cash hedge. Boring but brilliant. Sometimes the best hedge is just holding 20% cash. When everything crashes, cash lets you buy the bottom instead of selling it. Not sexy, very effective. One-click implementation. Some platforms offer hedge mode as a button. Binance has this. Not as flexible as manual, but better than nothing. Start here if coding scares you. Your automation like homework. Take your simplest hedge rule. Write it as if explaining to a 5-year-old. If this happens, do that. That clarity is what you need for automation. Share your simplified rule in comments. We're almost done, but everything we've covered leads to this final revelation. Part 8. The future is now. Your call to arms. Every system we've discussed, from basic stops to complex algorithms, they're all built by humans, limited by human imagination. But what happens when AI learns from millions of trades, adapts in microseconds, and hedges based on patterns invisible to human eyes? It's not coming. It's here. Machine learning models already analyze price action, order flow, sentiment, and adapt hedge positions in real time. Goldman Sachs and JP Morgan aren't just testing quantum computing for risk modeling. They're using it. Soon, you won't say if price drops 5%, hedge. You'll say I want to sleep well at night, and AI will figure out the rest. But here's the thing. The core truth that never changes. No matter how advanced tools get, the core question remains. What are you trying to achieve? Survival? Growth? Peace of mind? The tools evolve, the principles don't. The best traders from 50 years ago would still be profitable today. Not because markets haven't changed, because principles haven't. Protect your downside, let winners run. Stay humble. Survive first, thrive second. You now understand hedging at a level most traders never reach. From mindset to math, from psychology to platforms, from options to automation, from single trades to portfolio protection. But knowledge without action is just entertainment. Your 3-step action plan. Step 1, comment below. What was your biggest breakthrough? The 1.5x math? The psychology traps? Options as insurance? Share it. Your insight might save another trader. Step 2, Design your first rule. Just one simple hedge rule. Post it in the comments. I'll personally review as many as possible. Not perfect, just start. Step 3. Grab your tools. Download the free hedge system blueprint in the description. Includes position sizing calculators, example systems, margin requirement tables, no email required. The choice is yours. Path A. Close this video. Hope next time is different. Wait for the next disaster to teach you these lessons the hard way. Path B. Take action. Even one rule, even on demo. Start building your survival system today. Remember, you don't have to be the fastest, smartest, or most accurate. You just have to be the one still standing when the storm passes. Markets will crash, black swans will appear, your analysis will be wrong. But with proper hedging, none of that has to end your journey. You'll take hits, but not knockouts. Lose battles, but win wars. This isn't just about trading. It's about building a practice that weathers any storm, a system that lets you sleep, an approach that turns chaos into manageable risk. Final pattern. Interrupt. Every major fund, bank, and institution hedges. Every single one. They don't do it because they're scared. They do it because they plan to be here in 10, 20, 50 years. Do you? If you found value here, share this with a trader who needs it. Because in this game, we rise together or fall alone. Stay safe, stay smart, stay hedged. I'll see you in the next video. This is Trading Psychology Stick, reminding you, trade the plan, manage the risk, survive the storm.